Hey everyone, Zoran here from Your Empire here in Brisbane, and I'm joined by Chris Gray, the one and only from Sydney, our property professional down there from the Your Empire group, and Lauren Staley from Infolio and Your Empire in Melbourne. Happy Easter, everyone. Look, we're going to get straight into it today. There's a lot going on in the market. There's an epic amount of change and fluctuality in the marketplace. Let's get started with probably the most pressing and interesting news at the moment, which is the interest rates at the moment. We've finally seen a little bit of reprieve when it comes to the constant rise of interest rates. Chris, what are your thoughts on the stagnation of the rise by the RBA?
Oh, look, I think everyone had a whole massive sigh of relief yesterday, or effectively whenever you're watching this, then Tuesday last week, it was absolutely fantastic. And so, look, there's been so many signs coming out in the media recently that the things are changing, and we'll talk about some of the CoreLogic results later on. But look, that slowing of the interest rates is good. They're still talking about potentially having another one or maybe even two rate rises. But I think at least now everyone thinks that, look, we're almost there. Whether it goes up another 0.25% or whether it starts going down at the end of the year, at least now we're pretty sure this is about the highest it's going to get.
Yeah, for sure. Lauren, obviously only just breaking news. Have you felt any change in consumer sentiment or any change on the ground?
No, not yet. No, I mean, I think people were just bracing themselves for yesterday. Yes, it's a relief, but my view is there's still going to be another one. So, one to maybe two more. But I think that exactly as Chris said, because we've seen that there's been some slowing, that will make an impact on buyer sentiment. And certainly I think it'll make an impact on sellers as well. So it's not a bad thing. It's a good thing, even though I still expect there's another one to come along.
Yeah, and obviously with the Easter break, I feel like we may see a delayed reaction to the RBA's decision while it filters into the market, and also people return from the Easter break. So, listings here in Brisbane are very, very low. Our supply is exceedingly low. Will this rate change make any effect on that? But I know that we've got a lot of buyers out there, that's for sure. So let's quickly jump over, Chris, if we can, to the stats from CoreLogic results. I can see that New South Wales, to start with Sydney. Sydney is showing a rise off the bottom of the market here at 1.4% for the month. Have you seen that noticeably in the marketplace?
Oh, look, with all of these things, then it's funny with these statistics. Effectively, 1% on $1 million is 10 grand. So it's not necessarily the stuff that you can see. But I think one of the main points is this was the second month in a row that it's been positive for Sydney. And obviously Melbourne and Brisbane have followed shortly afterwards, and they've got their increase as well. And it's really just that sign. I think quite often it's not necessarily the dollars and cents of what people are paying, or I guess what they're paying in a mortgage. It's more the consumer sentiment. And that's the thing. So when you suddenly get 2 months of median price rises and you get a rate stabilization, it's just got to be a sign that after this year of pain, things are going to be changing. And so I think that will give more and more confidence over coming months, even if we have a few blips. So even if next month and it's a slight drop or we get the interest rate rise, I think people now know that things are kind of plateauing, which is great.
Yeah, for sure. And Lauren, what are your thoughts in Melbourne with this?
Oh, look, I just need to mirror exactly what Chris has said. I can't even really add much more to it. I think he's spot on. These are all indicators that really the worst of it's over. I think that they're probably, in reality, we're still going to see post, I think, as we sort of hit post-Easter, we're going to see a heap of stock hit the market of people who are getting rid of properties that they're not going to be able to hold once they flip over. And I think that's probably going to have the biggest impact on the buying market that we're going to see. I think it'll be a bit rough until the end of the year, just because sellers will have to sell, not necessarily want to sell. But that's a natural course of what we've been going through, and we knew that was going to take place. Because, I mentioned this in a story I did the other week. If you've got a mortgage of $10,000 a month, it's going to go up to 30. Now, how many months can you hold it potentially? So, those people will be looking to shift those properties before they need to. Or before it really kicks in. And I think that that's going to mean that between sort of April and December, it's going to be a bit of an interesting market to be in.
Yeah, for sure. Look, personally here in Brisbane, I think there's more than enough buyers actively in the marketplace to evaporate and absorb any excess stock that we might see as those interest rates start to kick in.
And I don't necessarily think there's going to be excess stock. There'll just be stock.
Yeah, for sure.
We don't have anything to buy.
Yeah,
there's nothing available. So
yeah, exactly.
Sell.
Collection. Yeah, exactly. Obviously, in rising interest rate environments, we see people's borrowing capacity start to be affected. And obviously, people need to probably start looking at more creative ways to review their serviceability and optimize their serviceability. Chris, do you have any suggestions for people out there who are hunting for finance or thinking about buying? What should they be doing in this environment to really optimize their borrowing capacity?
Sure. I think the first thing is classically going to a mortgage broker that deals with people buying multiple properties because they're generally more entrepreneurial. They see more heavy hitting kind of investors, and they're used to then going to maybe obscure lenders that can really maximize serviceability. So that's definitely worth it. Then take their advice, almost go on a financial diet. So stop spending those Uber Eats and getting the Uber taxis, get the bus and a packed lunch. And look, it sounds stupid, but go and do that for 3 or 6 months. It can change things. And then obviously think about getting part-time jobs. It's if there's a will, there's a way. So if you could go back in time to when properties were 500 grand and now they're $1 million, and you had certainty, you'd beg, borrow, or steal to go and get more income to buy that extra property to make that other 500 grand. And even if you've only got to do it for 6 months, who cares? It's not a big thing in the grand scheme of things. So I think that's the main things, but definitely get the advice. So if you're self-employed, I go to my mortgage broker, I say, how much do I need to earn in order to get a refinance or to get a new loan? I then go to the accountant saying, right, we need to set the accounts like this. So rather than minimize my tax, I want you to maximize my income. And maybe I've got to do some of that heavy lifting and do a few more sales calls and build up my business income at the same time.
Yeah, for sure. And Lauren, what's your thoughts, I guess, if people don't have a sufficient income, sufficient borrowing capacity to buy into the core markets that you believe is investment grade, should people just wait? Is that a viable option? Or should they look to team up with others?
That's a good question. I think that, look, I don't think buying property for the sake of buying property is the right way for anyone to go. I think you've got to buy the right property in the right locations with the right attributes, because we meet with plenty of people who have bought average real estate who are selling at a loss, right? Yep. Not advised by us. But that is a stark reality. You know, not all good real estate is good real estate. So I think that there are certainly, for us as a business, you know, our buying model is expensive for people, not expensive, but it's more expensive than it can be in other states, and it's more expensive than it can be if you're buying in emerging suburbs or suburbs that don't have historical capital growth patterns. But we are trying to make sure that we can look at places like regional Victoria and regional cities outside of Melbourne that have got really good infrastructure, good railways, great schools, where their affordability in the buying, you can buy in at a level that is much more achievable than what you can in Melbourne. And we're seeing similar growth patterns. It's not Melbourne, it's not Melbourne City, but it's still pretty bloody good. So we've been able to find some options for our buyers that we think are excellent and have high growth and good yields, because at the moment, it's all good and well to buy capital growth properties, but if it costs you too much to hold, people are going to sell them. So we found that balance of good capital growth plus solid yield.
Question without notice here. At what point does my budget shift from a metropolitan Melbourne to a regional hub? Where's the tipping point? What do I need budget-wise to be looking in those regional areas and then to be in the more metropolitan area?
I mean, that's an interesting question, though, because, Zoran, we buy houses. We believe in buying houses with land. If you can't buy a house with land, our next option for you to buy a really good capital growth property is a unit. You might be one of 2, 3 or 4 on a block. And then if you can't afford that, which, you know, a lot of people really want the house. So if they really just want to get a house on land, well, you've got to go to regional Vic if you're under probably about 700,000. But really now to buy a house in the locations that we want, you've got to be 800,000 and above. Yep. So if you're below that and you don't want a unit, then you've got to go to regional Victoria or a regional city.
Yeah, for sure. And Chris, just quickly, in your market, What's that pricing point look like for investment grade stock in your area?
Yeah, look, generally for two bedders, we're looking at about 1.25 to 1.75 million. The one bedders are kind of maybe 800 or 900 to the 1.25. But so sometimes we've been buying, say, stuff like a Newcastle is kind of going up the coast a bit. But we bought one recently in a place called Hillsdale, which is kind of further out from, obviously you've got Coogee Bondi beaches, then you go to the Randwicks, and then this is just slightly further away. But for a first home buyer, we bought a one bedder for 500 grand, and he was actually getting $600 a week. So normally our rental yield's only about 4%. This equates to about 6%. So again, do you get something much bigger up in Newcastle or somewhere regional, or do you still effectively get into the eastern suburbs, albeit on the outskirts, but you've then got the affordability that people have got that kind of money to spend on the rental?
Yeah, for sure. No, look, and I think this is the unique thing about working with companies like us, which is it's about your strategy, right? So what's your situation? What's your borrowing capacity? What type of property is best going to serve your investment strategy over the next 5, 10, 15 years? And we'll execute that by finding the best option in that market. And so this is where, unlike a project seller who's flogging product, we don't have a product, we have a service, and that's what we deliver to our clients. Guys, anything else to add as we wrap up from this month's wrap up?
Look, I think the classic thing of trying to time the market, you can never do it. And so our rule, or my rule, is always buy when you can get a mortgage, buy when you've got the buffer to carry any negative gearing or any special levies or anything like that, and you can buy the right property at the right price. That's as simple as it needs to be, or as complicated as it needs to be.
Yeah.
Just get in, because in hindsight, everyone regrets it every single time. If you could have bought in COVID now, you would have jumped at it because you would have made 20 or 30%, even with the 5 or 10% drop that we've had. So the main thing is if you can afford it, get in, because you will regret it.
Lauren, any final remarks?
What he said.
Look, again, it sounds a bit boring. We all say the same thing, but it's because we have a consistent message, and that's why we work so well together as a brand. For us here in Brisbane, I just purchased a renovator for my clients at $635,000 that 12 months ago would have been $735,000, right? So right now there is a great window where the market has subdued, but as the stats and attendance and open homes is showing, the market's recovering, and it's recovering quite strong. So I agree, guys. Don't try and time the market. If you're comfortable with your financial position, you could secure a mortgage, get out there and take action, because if you don't do it, someone else will. So, guys, thank you very much for your time today. Thanks for everyone watching. Tune in next time, and we'll keep you updated with Brisbane, Sydney and Melbourne across the Eastern Australian markets.